The dollar doesn't collapse with explosions, riots, or dramatic headlines. It weakens quietly, through incentives, through confidence, through slow shifts in behavior that most people don't even notice while they're happening. And that's exactly why the real story isn't about panic, it's about structure. For nearly 80 years, the US dollar hasn't just been a national currency, it has been the operating system of the global economy. Oil contracts are priced in dollars. Sovereign debt is issued in dollars. International shipping insurance clears in dollars. Central banks hold dollars as reserves not because they love America, but because the entire financial machine runs through that system. If you want to trade globally, you need access to dollars. If you want stability, you hold dollars. That dependency is the true foundation of its power. After World War II, the United States controlled roughly half of global industrial output. Europe was devastated. Japan was rebuilding. The US had factories, oil, food, gold, and military dominance. When Bretton Woods was established in 1944, the dollar was tied to gold at $35 per ounce, and every other major currency was tied to the dollar. It wasn't just a currency agreement, it was a hierarchy, and at the top was Washington. But here's the turning point most people misunderstand. When the US closed the gold window in 1971, the dollar didn't collapse, it evolved. It shifted from being backed by gold to being backed by global demand, especially energy demand. Oil exporting countries priced crude in dollars. That meant every country on Earth that needed oil had to accumulate dollars. To get those dollars, they either exported goods to the United States or borrowed in dollar-denominated markets. Those dollars then flowed back into U.S. Treasury bonds, financing American deficits. It became a loop, self-reinforcing, stable, and incredibly powerful. America could import more than it exported. It could run persistent trade deficits. It could finance wars, social programs, infrastructure, and stimulus packages. Why? Because the world needed the currency in which those deficits were issued. Foreign nations earned dollars and recycled them into U.S. debt. That recycling kept interest rates lower than they otherwise would have been. It allowed the United States to consume beyond what traditional economic balance would permit. But there's a structural contradiction hidden inside that system. To supply the world with dollars, the United States must run deficits. Those deficits increase debt. As debt rises, confidence becomes the only thing holding the structure together. This is known as the Triffin dilemma, and it's not a conspiracy theory, it's a mathematical tension. The issuer of the reserve currency must provide liquidity to the world, but the more liquidity it provides, the more its own balance sheet stretches. For decades, this tension didn't break the system because there was no credible alternative. Europe lacked political unity. China controlled capital flows too tightly. Gold was too rigid for modern transaction velocity. And every major crisis, 1987, 1998, 2008, 2020, paradoxically strengthened the dollar. Even when the crisis began in the United States, global capital ran toward U.S. Treasuries. Investors didn't ask, who caused the problem? They asked, where is the deepest, most liquid market? And the answer was always the same. Then something subtle changed. In 2008, the Federal Reserve expanded its balance sheet massively. In 2020, it did it again, faster, larger, more aggressively. Trillions of dollars were created to stabilize markets and prevent systemic collapse. Domestically, this worked, but internationally, it sent a message. The supply of dollars can expand without hard constraint, its stability requires it. That flexibility is a strength in crisis, but over time it raises a question. If supply can expand indefinitely, what anchors long-term value? Then came another moment, the freezing of Russian central bank reserves in 2022. Regardless of political alignment, the financial implication was clear. Dollar reserves are not neutral assets, they exist inside a geopolitical framework. For countries outside U.S. alliances, that realization changes strategic calculations. Holding reserves in dollars is no longer just about liquidity, it is about exposure. And when risk perception changes, behavior changes quietly. Central banks have been increasing gold purchases at the fastest pace in decades. Bilateral trade agreements in local currencies are expanding. Energy contracts are being settled in alternatives. These shifts are not dramatic, they are incremental. But reserve systems rarely fail in one dramatic event. They erode at the margins. The dollar today still rests on powerful foundations. The U.S. Treasury market remains the most liquid bond market in the world. American capital markets are deep and transparent. The U.S. military secures global shipping lanes. The legal system protects property rights in ways few countries can replicate. And perhaps most importantly, network effects dominate. Everyone uses the dollar because everyone else already uses it. To replace the dollar fully, another system would need to match all of that simultaneously. No current alternative does. China cannot allow full capital mobility without risking internal instability. The euro lacks unified fiscal authority and political cohesion. Gold cannot scale to handle modern transaction complexity. Digital currencies remain experimental and fragmented. So, this is not a story about immediate collapse. It is a story about gradual dilution. U.S. national debt continues to rise. Interest payments consume a growing share of federal spending. As rates increase, servicing that debt becomes more expensive. If foreign demand for Treasury slows, either yields must rise to attract buyers, or the Federal Reserve must absorb more issuance. Higher yields pressure the economy. Monetary absorption risks inflation. Neither option is catastrophic in isolation, but both accumulate constraint over time. Historically, reserve currencies lose dominance when debt burdens grow relative to productive capacity, when geopolitical commitments stretch beyond economic fundamentals, and when viable alternatives become just strong enough to matter. The British pound did not vanish overnight. It declined gradually across decades, accelerated by war and debt, until the dollar replaced it as the anchor of global trade. The United States today still leads in technology, energy production, and military power, but its share of global GDP is smaller than it was in the mid-20th century. Supply chains are multipolar. Trade is fragmenting into regional blocks. As globalization becomes more politically contested, the logic of a single dominant settlement currency weakens slightly. And slightly is all that's required. A reserve currency does not need to disappear to lose influence. It only needs to become less indispensable. If the dollar's share of global reserves drops from 60% to 45%, it is still dominant, but its leverage changes. If energy trade diversifies modestly, sanction power narrows. If borrowing costs rise even marginally, fiscal flexibility shrinks. The real risk is not cinematic hyperinflation, it is strategic erosion. The dollar is more than money. It is leverage embedded in contracts, trade routes, debt markets, and political alliances. If that leverage becomes optional instead of mandatory, the architecture shifts, quietly, technically, without dramatic headlines. The world is not abandoning the dollar out of ideology. It is hedging against concentration risk, and hedging behavior, when multiplied across dozens of central banks and sovereign funds, reshapes systems over time. So the question isn't, will the dollar collapse tomorrow? That's the wrong frame. The real question is whether the structural incentives that once made it untouchable remain intact. Because once a reserve currency stops being the only game in town, it stops being unquestioned. And when confidence becomes conditional instead of automatic, the balance of power begins to adjust, not in a single moment of crisis, but through 1,000 small reallocations that, years later, look obvious in hindsight. That is how monetary dominance ends, not with a crash, but with a slow redistribution of trust.